Thank you for joining us. It was a roller coaster day for the markets as investors look to make sense of President Trump's tariffs policies. The S&P 500 opened with a sharp drop before climbing back up. By the end of the trading day, the index was down just 0.25 percentage point overall. The volatility on Wall Street comes as the future of global trade remains uncertain. On Monday, President Trump threatened to put an additional 50% tariff on all imports from China. The move would be in direct response to China's decision last week to impose 34% retaliatory tariffs on U.S. goods. The 50% tariff would be on top of the existing 20% tariff the U.S. already imposes on Chinese goods, plus that 34% tariff the White House plans to enact on Wednesday. If President Trump makes good on this threat, Chinese goods will face import taxes of 104%. The European Union is preparing its own retaliation. EU members are expected to vote on a tariff package targeting a range of American products. The exact details are still being discussed within the 27-nation bloc. After spending his weekend at the golf course, President Trump was back at the White House Monday, hosting Israeli Prime Minister Benjamin Netanyahu. While they were in the Oval Office, President Trump was defending his economic strategy.
It's the only chance our country will have to reset the table, because no other president would be willing to do what I'm doing or to even go through it. Now, I don't mind going through it because I see a beautiful picture at the end.
CBS News MoneyWatch correspondent Kelly O'Grady joins us now. So, Kelly, stocks up and down Monday. Why was there so much volatility?
So investors were really focused on the short term, okay? I mean, there's so many arguments, pros and cons for the long-term strategy of tariffs. But in the short term, even the president has admitted there is going to be some pain. And so whenever there is a social media post or a retaliation threat or anything, these are going to create short-term impacts. And investors are focused on that because that's what's going to impact a company's bottom line, their sales, consumer spending. And that's what investors are focused on, company profits. And so you saw this in two key things today in the market. If you look at the chart of the Dow, we opened severely in the red, down close to 1,700 points. That was because over the weekend, China sort of increased their rhetoric when it comes to retaliation and made it seem like they weren't willing to negotiate anymore. And so we opened down. And then there was this little spike of green in the Dow today when there was a report that it turned out to be false, that maybe there might be a 90-day pause when it comes to these tariffs. And so both of those would mean short-term impacts, and investors reacted accordingly, very negatively and very positively.
And then the administration came back and said that that was fake news. What do you make of this latest tit for tat with China? I mean, increasing the tariffs to 104%. What would an all-out trade war mean, and what would 104% tariffs mean for the average consumer?
I mean, it would mean that businesses would not be able to pass that, they would not be able to eat that full cost. They would have to pass some of that on. I mean, imagine that, 104%. That is double the cost of what they are paying to import that good into the U.S. And so what does that mean for the economy? It's likely going to mean a slowdown in consumer spending because those goods would be so much more expensive. And it would likely also mean a slowdown in the economy because consumer spending drives so much of our economy.
So we consume so much from China that this alone could create a slowdown in the U.S. economy.
I mean, there just are certain things that you look around, right? So much of what we wear, so much of, our technology, it's a big deal. And that was already a big deal when we were talking 54%.
Yeah. All right. So JP Morgan Chase CEO Jamie Dimon said in a letter to shareholders Monday that the tariffs will, I'm going to read a quote here, likely increase inflation and are causing many to consider a greater probability of a recession. We're very careful with the R word. I want you to explain why. But also, he didn't criticize the president directly, but that's still a pretty significant statement.
Right. So we are very careful with saying recession because we don't want to create fear and create a situation where people react so viscerally that we sort of make a recession happen. And by the way, just because analysts are predicting something to happen doesn't mean they're always right if you go back in the past. What is significant, though, about Jamie Dimon saying that there will be a slowdown in economic growth, because he did use those words, is that just a few months ago, back in January, he said people should not worry about tariffs. They're important for national security. So this is a departure from his original rhetoric on that. This is also the first CEO of one of the major banks to come out publicly and say this.
So was he saying that in reaction to what the markets were doing or in reaction to a more aggressive tariffs policy than he was expecting?
It was that. It was the April 2nd reciprocal tariffs. It's just such a high percentage.
President Trump said Monday again he wants the Fed to cut interest rates. What would that do at this point in the economy? And we know that the Fed operates independently, but how likely is it that we'll see a cut soon?
Not likely that we're going to see a cut soon, unless we see the jobs report or meaningful economic data show that we are slowing down. If we were to see an interest rate cut, you would likely see more spending, more people getting into maybe buying a home, different things like that. That would cause inflation to go higher. I will say, look, the economic data does not say we are in a bad way right now. It's just the what if here.
Okay. Kelly O'Grady, thank you so much.